It's that time of year when the real estate market starts to pull some tricks on us here. Halloween's on its way, and we're almost into November. Let's take a look at what happened in week 43 for Des Moines and Central Iowa. Hey there, welcome to the show. This is Les Sulgrove. This is DesMoinesMarketValues.com, weekly market update for Des Moines and Central Iowa. It's week 43, which means we're at the very last of October. Next week's show will be the end of October report. So thank you all for tuning in every week. If you enjoy the content and find this valuable, please do me a favor and hit that share button, the subscribe button, and then also click on that notification bell in the video. Your support helps this channel grow and helps me create more great videos for you every week. So with that, let's jump into this week's show here. So we're going to talk a little bit off track normally. I'm going to show you some graphics that I did some research on this past week based on Dr. Yoon's conversation he had with us at the Iowa Association of Realtors convention 2 weeks ago or a week and a half ago in downtown Des Moines. And it was wonderful to see him there and have him share the information. He talked at the very end about a graphic or a statistic dealing with mortgage delinquency in the state of Iowa, which made me do kind of a double take. It's a number that we really don't follow in the local stats. We follow bank-owned properties, but I told you last week I was going to do a little bit of research and see what I could come up with here and maybe expound upon what he was talking about. So um, basically, this graphic you see on the screen is from the Consumer Financial Protection Bureau, the CFPB is probably how you most likely know this. It's as current as March of 2024. Those stats like that are sometimes 6 months behind, and in this particular case, it is exactly 6 months behind, March of 2024, and this represents the United States and then, of course, the state of Iowa with a little heat map there showing the percentages of mortgages that are delinquent, not seriously delinquent, just the ones that are 30 to 90 days delinquent or 89 days out. And you can see there in the middle that it shows that the national average is 1.6% of mortgages across the country are within 30 to 90 days in delinquency, where Iowa is at 1.4% of that at that delinquency rate. So we're better than the nation, and I still think that 1.4%. I believe that's a pretty standard number. And we'll talk a little bit about what Dr. Yoon basically told us at that meeting in a little bit here, but you can see that there are some states that are farther behind. It looks like Louisiana and Mississippi are both closer to that 3.5 to maybe 4% range down there at the very bottom of the state. So as far as the seriously delinquent mortgage interest rates, or more not rates, seriously delinquent rate of defaults here. Nationally, again, this is a national number, 2.13% are in the what's considered a seriously delinquent state, and that means that they're at least 6 months or more behind on their mortgages. So that is pretty serious. And the graphic you see down below here shows you a green line, which is kind of the one we want to focus on. That's purchase mortgages versus refinance mortgages. So refinances are not faring as well as purchases, which kind of makes sense. If you're refinancing, you're I can't say that word, refinancing for a reason, and maybe affordability is that issue, and maybe that's why that refinance default rate is a little bit higher. But both are not too far apart. 2.02% on the 6 months or more delinquent rate nationally. And it's just a slight downturn there. You can see right there, it just slightly came down. And then on the refis at 2.64%. And let's see, make sure my slides, there we go. Oh, my heads, I didn't check this. My head's in the way of the graphic. Basically, a lot of people are going to go, well, how does this compare to 2008 and 2009 when the global financial crisis really hit? And so what I did was a little bit more research, and I went back and I asked the question, what were these delinquency rates back in 2008, 9, and 10, and basically at the height of the crisis in 2009 and 10, there, Fannie Mae and Freddie Mac, which are they're both GSE entities. Fannie Mae basically loans to the larger commercial banks, and Freddie Mac does the smaller banks, thrifts, and credit unions. So the 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 delinquent rate at that point for Fannie Mae was 5.5%. And it makes sense that, those are the larger commercial banks. The smaller banks were a little bit more conservative, likely. Credit unions a little tighter restrictions at the time, although restrictions back then were kind of out the window with the liar loans that we were experiencing. But the 4 to 5.5% is the default rate back then. So we're half of that, and I think that's on that 6 months or more. That's pretty. It's still up a little bit, but I think that's pretty much more common from where we typically are on those 6 months or more delinquent loans there. So back to Dr. Yoon. This is the graphic that he provided us at the Iowa Association conference, and it was basically a slide from FHA uh, that showed the increase of Iowa's serious mortgage delinquency rates. And again, this is 6 months or more, the seriously delinquent ones, were up by 1%. And over the previous month is I'm sorry, over the previous year. So a year ago, it said that we were, down below here. I don't quite follow his graphic, but I'm going to take his word for it, that it shows that it was up by 1%. But what I ended up doing was I researched this actual data from Dr. Yoon's presentation, and this is where it came from, the Federal Housing Financial Authority, FHFA. And you can see that, this kind of broke down essentially the different types of delinquencies and foreclosures and defaults in the state. And again, this is for Iowa only here. And so you can see that right here at 241 loans are in forbearance currently as of June 30th. So this goes back to just June, but 241 homes are in forbearance. And those are basically loans that the lenders basically allow the buyers to go in and either pause their payments or make an adjustment to the loan terms. Maybe they let them stop making payments for a period of time and then added those times onto the back end of the loan. So 241 of those, and that's a pretty low number in my book, I would think. As far as delinquencies, again, here we go. These are those GSE seriously delinquents. 1,272 was the actual number of GSE delinquent loans out there, of which it makes up about 5.5% of Iowa's uh, current delinquent loans in the process. The foreclosure prevention actions, these are where maybe the banks have been working with the homeowners, either to do a loan modification, adjust the mortgage rates. Maybe they were taking advantage of Fannie Mae's Home Saver Advance charge-off program. Maybe even doing some deed in lieu transactions where they basically gave the property back without affecting credit reports for the homeowners. And then other actions also consisted of payment deferrals, short sales, and some more of those deed in lieu. So the total there was about 40,000 loans are currently in some sort of a foreclosure prevention action, which is good. They're trying to get them worked out, and that's obviously they don't want to take those homes back. However, the REO count, which is down there at the bottom, that's the one that we really kind of follow in our local stats. This is the bank-owned inventory, and it says right here that 162 homes as of the end of June were in the bank-owned process. So they have gone back to the bank, but they have not gone through foreclosure process, or they've gone through foreclosure, but they haven't been sold out of the bank's inventory. So 162 of those homes. And so how does that compare here to what I track? And this is basically the weekly count in the Des Moines MLS showing you how many homes we have tagged as bank-owned properties. Now, this is making an assumption that the homes in the MLS are tagged properly. So there's a category you can enter your listing in and tag it as a bank-owned property. And assuming that this is correct, we've only got 25 homes out of that. What was it? 162. 25 out of 162 homes are currently showing up as bank-owned in the MLS. And if you look at that on a plus or minus units from a year ago, this is just kind of shows you that we're really about 10 above or 10 below at any time. This number goes up and down by about 10 units over time. And again, with only that few homes that are currently in bank-owned process, this is still a pretty low number. So I'm not too concerned with this. I think this is kind of normal for our market. If we go back to this graphic, you can kind of see the year over year. There's a few more this year than the past year, but when we're only talking, 25 or 30, the week 41, we had 31. It looked like 31 properties, and then those tend to sell. So again, not really being too concerned with those numbers there. So also in the research, I uh, found a very, very good article this past week from Realtor Magazine, and it was talking about the mortgage rate that buyers say that they're waiting for, and it's um, kind of like what will make me move interest rate. And so I took that information, I put it into a graphic that fits onto my slides here. By the way, if you see these URLs at the bottom of any of the slides, I got several URLs this week. They'll all be included in this week's show, so you can go in and do your own research and actually see these actual articles that I was talking about. But this is the make me move interest rate, and they surveyed a number of home buyers and sellers out there, or home sellers out there, that said, where is it going to take interest rates to be before I actually decide I'm going to move? And by far, it looks like somewhere between that 5.5% and 6% interest rate is really where we could start to see the homeowners come back into the market and jump into the buyer pool. So it kind of makes sense a little bit, because currently we're at 6.54% as of October 24th. And this same group would have said only 3% of them would have jumped in. And we're kind of seeing that a little bit. We're not seeing as many homeowners and home sellers jump into the market yet. The market's still active, and the existing inventory is selling, but um, we're just seeing, you know, we're still seeing homes coming on the market every week by existing homeowners, but just not at a pace that we'd like to see. And this is kind of evident when, if you look right here, this red line. This is the 30-year fixed rate mortgage rates year over year, and comparing it back to the previous 4 years. In the month of September, which is ended right about here, we were very close to that 6%. And if you recall, the end of September, actually the whole month of September, we were more active in September than we've been in a long time. And I think a lot of that had to do with the fact that mortgage interest rates were actually dropping nationally down around that 6% range. And obviously locally our rates are much lower than not much lower, but they are lower than what the national average is. So we were actually seeing mortgage interest rates locally here around that 5.5 30-year fixed rate in many instances. But what's happened since the 1st of October is we've seen nothing but increases every week with mortgage rates, and we're now back up close to that, over 6.5% is the 30-year fixed rate average. Again, understanding that our local market interest rates might be just a little bit lower, but still above that 6% right now. And that's probably having a pretty solid effect on kind of what's happening in our local market here. So to kind of take a look at how that looks, you can see again overlaying the red line, which is the mortgage rates. And you see right here, this is that month of October increase in rates. The reason it doesn't end with this week is because mortgage interest rates come out. The national average comes out on Thursday. So this is as of last week, and then next week it'll fill out for the following. But you can see that inventory is very, very slowly starting to increase as we get toward the end of the year, and we still have not hit that 4,000. We're 18 homes away there. Is that right? 18. Can't do my math. 28 homes away from 4,000 for the end of the year. Would love to see us hit 4,000 homes for more for sale, but that's kind of where we're at. But I did say that, inventory is continuing. We've seen a downward trend. The last 4 weeks has been a downward trend. However, we're still outpacing last year's pace. with homes coming onto the market. And I think, again, if we were to see those rates drop again, we'd tend to see this number bump up. Maybe not directly, but indirectly it would bump up because as new homes come on, we have home buyers out there that are pretty much buying them up, a lot of the new inventory as it comes on. It looks like we got about 2 more weeks of a good push of inventory if we do what we did last year. And then once we get into close to Thanksgiving, which would be indicated by this low right here, we're kind of coming down to the final stretches and the slowdown for the winter market until we get into January. So we've really got about 3 weeks, maybe 2 or 3 weeks left here before we start to see the big slowdown. As far as sale pendings go, this is the one that gives me the most confidence in the marketplace. And you can see that last week in week 42, we were below a year ago's last year's number, but this week we kind of bounced back. And with 172 homes under contract, that's a pretty good number. And again, if we go back to this one, you can see we brought on 293 homes new to the market and put 172 under contract. So between that and homes coming off the market for being expired and things like that, that's where our inventory level growth kind of comes into play there. But I'm happy to see that number stay up. And again, it kind of shows you again that same pattern. About 3 more weeks before we hit Thanksgiving, when the market really starts to slow down, and then a little flurry, just before the end of the year. So last slide here is the all homes closed year to date. Again, just to give you an idea, with that activity, we are making up some lost ground. We're now only 193 homes closed behind last year's closed sales. So we are catching up to last year's closed sales. I think if we have a good 3 weeks here and a solid December after Thanksgiving, a couple weeks there before Christmas, I think it's very possible that we can end up closing that 13,200 year-to-date or yearly close that we did last year. We're at 10,885 as of today. Again, that's 193 behind last year at the same time. So all right, guys, that is the show this week. Next week is the end of month, end of October report, and we'll take a look at kind of what's happened in all the different categories, as well as some of the local metro numbers. So with that in mind, have a great week, and we'll see you all again next week at this same time. Take care.